Welcome to our channel. So, you're ready to buy a home, but your borrowing power isn't quite where it needs to be? Or maybe you're wondering how much more you could borrow now that the RBA has cut rates again in 2025? In today's video, I'm breaking down 7 proven ways to boost your borrowing power, whether you're a first-time buyer or looking to upgrade. Stick around till the end for a bonus tip that most buyers never even consider. Let's jump in. Tip 1 is to lower your existing debts. The first thing lenders look at is your ability to repay debt. So if you've got a car loan, personal loan, or credit card debt, this can directly reduce what you can borrow. Even if you're making repayments on time, those debts are factored into your serviceability, meaning how much debt you can reasonably take on. Start to pay off smaller debts if you can, or consolidate to lower repayments. Tip 2. Reduce your credit card limit. Here's something most people overlook. Even if you don't owe anything on your credit card, the limit still counts as a liability. So if you have a $10,000 limit, the bank assumes you might use all of that even if you never do. Reduce unused credit card limits. Even dropping from $10K to $2K can improve your borrowing capacity. Next is to increase your income. Easier said than done, but even a part-time second job, freelancing income, or casual weekend work can boost your application. Lenders love consistent, verifiable income. It can also help to include things like regular overtime or allowances if they're ongoing. Start from now! Gather pay slips or letters from employers confirming extra income sources. Tip 4. Review and reduce your living expenses. Since the tightening of responsible lending laws, banks now closely assess your spending habits, especially discretionary expenses. Streaming services, subscriptions, dining out, and afterpay can add up quickly. For the next 3 months, keep your spending tight and controlled. Create a borrowing-friendly budget. Tip 5. Consider applying for your home loan jointly with someone else. This could be your partner, a close family member, or even a trusted friend if your situation allows. The key benefit here is combined income. Let's say you earn $70,000 a year, but your partner earns another $60,000. Together, you're assessed as having a $130,000 income, which significantly boosts your borrowing power. This could mean tens or even hundreds of thousands more in potential loan amount, depending on your other commitments. But here's the thing, you're also sharing the responsibility. So if you apply together, lenders will assess both of your debts, credit scores, and spending habits. That means if your partner has a HEX debt, a car loan, or maxed out credit cards, that affects you too. So before jumping into a joint application, ask yourselves, are both credit files in good shape? Is there trust and transparency around finances? Are both parties ready to take on this long-term commitment? If you're thinking of applying with someone else, run 2 comparisons. First, calculate your borrowing power as a solo applicant. Then calculate it jointly. A broker can help you model this quickly and show you which option makes the most sense based on your goals, income, and any future plans like having kids, changing jobs, or relocating. In some cases, we even explore a guarantor loan where a parent helps boost your application without being a co-owner on the property. That's a slightly different strategy, but still worth knowing about. Drop a comment if you want a side-by-side solo versus joint borrowing power breakdown. Tip 6. Choose a lender with favorable assessment criteria. Not all banks assess borrowing power the same way. Some use stricter rules, while others are more flexible with casual or self-employed income. This is where using a broker really helps. We can match you with a lender that suits your situation, not just your credit score. Don't just walk into your regular bank. Explore multiple options. Last tip, extend your loan term. If you're okay with longer-term payments, a 30-year loan term can boost your borrowing limit compared to a 25-year term because the repayments are lower month to month. But be aware, it also means more interest paid over time. Ask your broker to show you comparisons between 25 and 30-year scenarios. All right, as promised, here's your bonus tip, and this one's especially useful for first home buyers or anyone struggling to save a full deposit. Let's talk about government schemes. In 2025, there are several programs designed to help eligible Australians get into the property market with as little as 5% deposit and without paying lenders' mortgage insurance, which can save you thousands up front. The most popular one is the first home guarantee. Under this scheme, the government essentially acts as your guarantor for part of the loan, allowing you to buy a property sooner without needing a 20% deposit. There are also other regional or state-based grants that can stack on top of this, like stamp duty waivers, rebates, or shared equity programs depending on where you're buying. Here's the catch. You need to meet specific criteria like income caps, being an Australian citizen or permanent resident, and buying within certain price limits. If you're unsure whether you qualify, talk to your broker. We can check your eligibility and apply through participating lenders. It could mean the difference between buying this year or waiting another 2-3 years to save a full deposit. So there you go. 7 ways to boost your borrowing power in 2025, plus one bonus strategy that could save you thousands. Thank you so much for sticking around until the end. We really appreciate your time. If you found this video helpful, please like, subscribe, and share it with your friends or family. Be part of the Fortis community, where we turn financial knowledge into everyday confidence. Need guidance on your financial journey? Reach out to us anytime at finance@fortiscapital.com.au